Here we go. Good day. I'm Martin Gago with Market Radius Research. It's Wednesday, March the 8th, and we've got CEO Dave Harper of Geodrill joining us today. Geodrill is a drilling services company for the mining industry operating in West Africa, Egypt, and South America. And Geodrill just announced its Q4 2022 results, which were very strong. Relative to both historic results and really in absolute terms, most any company would love to have this kind of growth, profitability, return on invested capital as Geodrill is posting right now. Dave is going to walk us through the quarter, but please remember, this is not a recommendation nor investment advice. We're here to learn about the company and its news and its earnings for the last quarter and year. Dave, thank you very much for joining us. And why don't we start this off by giving us a quick overview on the most recent quarter and last year's financial performance.
Thank you, Martin. So as you pointed out, it was a solid year. It was an outstanding fiscal year. High level, we did 20% year-over-year improvement on top line. We did a 30% improvement year-over-year on our EBITDA, and net earnings were up 34%. We've been cash flow positive for quite some years now. We initiated a dividend 3 years ago in 2021, and we increased that last year in 2022, and we've just announced that we're going to improve that yet again into 2 semi-annual dividends of 4 cents. So yeah, that's improving all the time, indicative of the business itself, which is improving all the time. You pointed out that we're a drilling services business. And drilling services businesses are basically proxies for mining, and mining is very strong at the moment, particularly in the regions where we operate, and our numbers are indicative of that.
Dave, I think when a lot of people think about drilling, they think of drilling as for like little junior explorers that are punching holes into moose pasture and trying to find the next big target. Well, that's part of your business. A lot of your clients are the big mining, not the exploration companies, but miners who are drilling out their expansion plans and so forth on known resources. So could you just tell us a little bit about who your client base is in primarily West Africa, but as well in Egypt and now in South America?
Mm-hmm. It's actually a great question. It's very topical because we're now actually in our 25th year of business, having started in 1998 with one rig and one contract in Ghana. And one of the customers' names that most people in Vancouver will remember was Redback Mining. Now that was one of our very, very early customers. They were a junior explorer back in 1998 when we drilled the first hole in that project. And as things have evolved, that company got bought by a senior miner, and it's just changed hands again. But here we are 25 years on. The project itself has had 3 owners. We've actually never left site. We've been there for 25 years since we drilled that first hole. We went from discovery, we went through DFS, and now we're basically working in the open pit and in the underground. And this speaks to the recurring nature of the revenues that are generated from the exploration and drilling business. Our customers today are companies like Kinross and Newmont and Anglo and Golden Star Resources, the large producers. But those large producers all started many years ago as juniors. And basically, somewhere along the line, there's been some corporate activity. So what's driving our business today is depletion. So what happens is discovery gets made. Mining company goes into business with a mine, 2 million ounces to 200,000 ounces a year. So you can imagine after year 1, what happens is they've depleted 10% of their reserves. And so cash generated from operations is then recycled back into further drilling to drill underneath the ore body and extend the ore body. So typically, some of these operations would have started at 200-300 meter projects. Well, we're now drilling holes down 2 kilometers, 2,000 meters underneath what was just, the stuff that we were drilling for the juniors way back when. Yeah, and this has enabled us to actually grow the business over the 25-year cycle, because we have never lost a customer. All we've ever done is added customers, and we've grown as our customers have grown. Now, coming back to the bigger question, why West Africa? Well, what attracted me to the business way back when was I was just a young driller looking for an opportunity, and I stumbled across this place that had missed 50 years of modern exploration. And so I could see a lot of low-hanging fruit that needed to be drilled. And as I was saying, that was the start of Geodrill. And it's been a 100% organic growth story since the get-go. All of that has been 100% organic growth. Rigs generated and basically bought from cash generated from operations. Never done, not an acquisition in the whole thing.
All right, you're an investment banker's worst nightmare. You don't need their services to raise money and grow. About what percentage of your revenues are coming from sort of like mining companies that are doing expansionary drilling versus like explorcos who are sort of dependent on the capital markets to raise money to punch some holes in and do that whole cycle?
Well, it waxes and wanes a bit. At some point, at various points in the cycle, it becomes a junior market. But it's not now. For the meantime, for the most part right now, we're drilling mostly for miners and doing that expansionary, that depletion type repletion type drilling. So I can remember at times. So at the moment, we'd be typically say an 80%, 20% split at this point in time, 80% miner, 20% junior. But I know of times in the cycle when it becomes 60% junior and 40% minor.
Yeah. Okay. So the miners they've got high commodity prices, they're generally gushing cash flow. So they've got lots, and they want to make sure their assets live as long as possible. So they've got lots of money to spend to keep their assets alive and try to find growth in them wherever they can. So that's kind of a good signal for what you guys are doing.
Sure. And I mean, there's a bit of M&A getting around as the juniors out there, which are obviously beholden to the capital markets, and some of them are struggling because the capital market support isn't there. So you're starting to see a lot of M&A where the big companies, gobble up the little companies, and then they gobble them up for a reason to further explore them. And that drives our business further as well.
Yeah. Can we talk a little bit about Q4? I follow the stock quite closely, and I know other people who do as well. And I think people were surprised at the strength of Q4. You could see it in the stock price as well, just ahead of the results. The share price dipped, maybe because you had previously talked about Q4 maybe being impacted by the rainy season and being a little bit slower. And it seems like consensus was that it was a stronger Q4 than expected. What happened in Q4? How did it perform into your perspective?
It actually surprised us to the upside. We alluded to the fact that we had a later wet season than was expected, which impacted. It resulted in a strong Q3, and we kind of were, sort of basically alluding to the fact that it probably wouldn't be as strong a Q4 because of the late arrival of the wet season. And that much was true. The wet season did arrive late. It came and it left. And then what happened is we had a very slow start to Q4, and we had a stonking middle. November was recorded. It was numbers I've never seen before. That's as I say, indicative of what's going on out in my space there at the moment. And then, of course, as we rolled into December, we had a record beginning of December. The first half of December was the record, and then we slowed down for the Christmas break. So that's pretty much how our Q4 played out for a slow start, very solid middle, and a very robust December. This all augurs very well for 2023, which is off to a really solid start. We had a solid January. Very robust February, and March will actually probably flatten off. It'll be an improver over what it was last year, but the end result is that Q1 is going to be solid. Q2, if you remember what happened in Q2 last year, is we started to see the benefit of all those new contracts that started to kick in. And so I'm expecting that Q2 will be a little flatter, but not. It'll be an improver, but it's probably not going to be on a percentage basis as solid as our Q1. I think how Q3 is going to play out is a little hard to say at this point in time, because that one's always a bit of a slippery slope when it comes to the wet season. But I think it'll be solid. It'll probably be like Q2. It'll be an improver year over year, and I think Q4 will be the same. And this is all being driven by the thing that's, the one KPI that sort of basically drives our thinking with everything is utilisation of the drilling fleet. We have a drilling fleet, a fleet of rigs, and what percentage of the fleet is busy. And in our case, that just happens to be very solid at the moment. The actual number for your information happens to be 77%. And if we look at what our utilisation was through Q4, it was 70%. These numbers I'm throwing out there are probably the best in the industry at the moment. High 70s utilisation. It really doesn't get much better than that.
Yeah. Because part of your success as well is that you put a lot of emphasis on maintaining your equipment and making sure it's properly operating, that you don't have failures, or they operate at best efficiency when they're in. So you're pulling them in frequently for maintenance, tune-ups, and so forth. So that's part of that. So if you got up to 90% or whatever, that'd be kind of concerning, because you could be having some breakdowns in the future and so forth. So anyways, so is sort of high 70s sort of the best it gets with you? And if you go off that, then something for a longer period of time, that's not really sustainable?
We peak at 80, 85.
Okay.
But when we talk through the quarter, it might average 75. So we might have a 70 and a 85 and a 75 in there. We'll call that average 75. At the moment, we are seeing utilisation. We're seeing some peaks there of 80, 85. Yeah. But the first week of January, you can imagine people are still getting back to flying in and getting organised and to get out in the field. So when you talk average utilisation, 77, it's as good as it gets in the world anywhere at the moment. These would be the leading numbers in the world, in the drilling world today.
All right. The first half of the year, Q1 and Q2, that isn't really like weather dependent. That's more just business dynamics. The weather is generally good unless there's something off. It's more the back half of the year that has sort of weather dependent or external factors affecting your business. Is that fair to say?
Yeah, no, it is. And historically, Q2 is our strongest quarter.
Okay.
It just is. And our Q1 is generally, it's below that because of the slow start, because of the January, and then February is a short month. I think that between Q1 and Q2 this year, I think they'll be a bit flatter. Q2 will be stronger. But in terms of percentage improvements, it won't be as solid as on a percentage basis, a relative basis. Q1 will stand out for sure. Across the 4 quarters, I think what investors can look forward to is another good solid year.
Yeah.
I would just hasten to add that if we look at the last 2 years, we were coming off COVID. We had a 40% year-over-year improvement, so we were coming off a low base. The year that we've just put in is a 20% year-over-year improver. I'm talking top line.
Yeah.
Now, as we roll out through 2023, please know that during 2022 we had a bunch of new contracts that started. Now, some of those contracts were renewals, so that was existing business that was rolled, and a good chunk of it was actually new contracts. Okay, yeah. So somewhere in that 20% improvement that we put on year over year, that will not be new business as we roll out into 2023. That will become rollover business, and so for that reason, I would just, I certainly wouldn't be indicating to anyone that we're going to do another 20% year over year improver. It'd be more like in the sort of zip code of about half that, I would have thought.
Okay, all right, and Since we're talking about revenue growth, you've got a couple of drivers. You've got your sort of home base, your of West Africa. You're focused on the gold. You have discussed in the past non-gold drilling. That's a growth opportunity for you, like the critical metals, the battery metals, and so forth. And then you've also got your growth drivers in North Africa and Egypt, and then you've recently expanded down into South America. So, and then I believe it was Chile that you expanded into from Peru initially. So you've got some growth there, but it is still a relatively small base of business compared to Africa. Talk about those growth drivers and those growth markets that you've entered into.
Well, even within our traditional market, which is the West African market, we are actually drilling now for critical metals. We have two lithium jobs that we're drilling at the moment, and they're starting to really pop up on our radar as you know, significant drilling programs. So that's within the West African market. We are actually, you know, when you think of West Africa, you think of gold. It was once called the Gold Coast, actually, for a reason. There's a lot of gold there. And so in more recent times, drilling for pegmatites, hard rock lithium mining in West Africa has come to the fore, and there's a couple of projects that are being developed, and we're fortunate enough to be drilling a couple of the fairly large ones. Moving on, so West Africa, I think, is going to be more of the same. It's just going to be a robust market for us, and it will continue to grow. But the big growth we're seeing at the moment is in places like Egypt, for instance. Egypt, you know, if I broke down the demographic for you, between 2021 and 2022, it grew from, call it 1% of our business to 10% of our business. So of the total revenue that you saw in 2022, 10% of that came from Egypt. So we honestly couldn't be happier with Egypt as a growth market at the moment. That's really significant in the first year of business. Then, as we moved to South America, you know, you will recall that we were in Peru, and it's obviously no secret that there's a few, you know, issues going on in Peru at the moment with what is it, impeachments, whatever. We don't get involved in the political discussion and things like that, but obviously it's you know, it's obviously affected drilling. So we had some rigs that were basically available in Peru when suddenly we bumped into a customer of ours, actually from West Africa, who had just acquired a project in Chile, and asked us if we'd be interested in putting some rigs down there. Obviously, we had some rigs, so congenial, very, you know, an opportunity at the time, and so we mobilised some rigs. Well, that is a new market for us, and we had not drilled in Chile before, and fortunately, that customer has actually made a fairly significant discovery, we understand, and it's gone to a drill out in the rather more quickly than we thought it would, and so we're very busy mobilising all the rigs from Peru at the moment down to Chile, and they're actually asking us to add some rigs over and above that. So couldn't be happier with Chile. It's a very interesting market. The copper thing, we like base metals, always trying to diversify away so that we can reduce that reliance on gold, although we like gold. Yeah. And we think gold has a huge future. It's imprudent not to, you know, if you have the opportunity to balance that risk a little more, then you'd obviously take that. So we're looking at it from a diversification geographically, from a commodity split point of view. We really like Chile.
Yeah. Yeah. Just going back to West Africa, like the big gold producers globally are Russia, China, the US, Australia, and Canada problem. But the Gold Coast, it's broken up into so many different countries. It's sort of, you lose the impact of that region as like the Gold Coast or West Africa. If you combine that all, how would they rank as sort of a global gold producer, the region you operate in?
Great question. So, you're spot on. Where does all the gold come from in the world if you'll rank them by country? You're right. You're spot on. China is number one. Australia is number two. Russia is number three. Between them, they produce an average of 335 metric ton per annum. Now, interestingly, if you take the 12 West African countries and you took the 6 gold producing or official gold producing countries, the production from those 7 countries comes to 456 metric tons. 50% more gold is being produced in West Africa than is coming from the largest producer in the world. So how big is that area? All right, so if you were to condense those 7 countries on a footprint basis, it would fit inside of China twice. So I think a lot of folks, investors, overlook the importance of West Africa. I'm often asked the question, why West Africa? It's pretty easy. It's a pretty thing, because that's where the drilling is. Why did the bank rob a bank? Because that's where the gold is. I drill in West Africa. You know, you can tell by my accent, I don't come from that part of the world. I come from Australia. I come from down under. Well, nothing would be simpler than, you know, going to the footy every weekend or go fishing and, you know, watch my drilling rig from my back porch. But I chose to go to West Africa as a young driller many years ago because I thought that the region had been overlooked. It missed 50 years of modern exploration. And so I've stuck about it 25 years ago. And, when, you know, West Africa probably wouldn't have even shown up on the radar as a gold producer, and stuck with it. And as a result of all that drilling that we've produced, along with some of our competitors, it's now really become so. Anyway, did I get it right? Did I get it wrong? Well, evidently, all the big guys. I mean, Dumont are there, Barrick are there, Anglo are there, Kinross, Golden Star. They're all there. They're all our customers. Endeavour, huge amount of gold production, you know, from these names. So where are they? Where's all the gold coming from in the world? It's coming from West Africa. And that's why Geodrill is in West Africa.
All right. You've got the growth drivers of South America, Egypt, and then just more drilling in West Africa. Are there any other, like, should we be expecting growth initiatives anywhere else in the world? Or obviously South America is a big place on its own for mining, or are you just trying to focus, make sure you execute properly in your existing markets and in your new markets, or could there be expansion anywhere else?
Tim Hortons model, okay? Start a coffee shop, wait till it's going well at a coffee shop. We move into a region like Ivory Coast, which today speaks for 35% of our business. I'll wind the clock back to when we first entered that market. It was 2% of our business, just like Egypt was 1% of our business. And last year it was at 10%. We move into regions where there's multiple customers, where there's big opportunities that are seriously under drilled, and that's where we see opportunity. And we get our rigs in there and we start drilling, and we start working for customers that we would hope would make a discovery. One of the things, I'm not sure I've ever mentioned this before on your calls, but I will today, is that we have never lost a customer in 25 years. I mentioned that one of our early customers back in the day was Redback Mining. At that particular project, although it's had 3 owners along the years, we have remained the #1 driller. So we've never actually lost a customer in 25 years. The whole business model has been about what this business is about, which is customer service. Keep the customer satisfied. If you do that, our customers all have a serial requirement for drilling. Keep the customer satisfied. They're not going to change drillers, provided, you know, we still price things competitively, and we continue to deliver the highest international standards in terms of safety and ESG. And ultimately, for shareholders, that's important because it means recurring revenues. You know, I gave one example, which was the Redback project. But that's just one. It's one of many that where we've arrived, and we've been at site for, 25 years.
All right. What is the biggest factor limiting your growth? You did 40% because coming out of COVID, and then last year was just a solid 20% year. This year, it sounds more around the 10% kind of a range. If you had more rigs or more trained staff, or is there anything that's limiting it? Like if you had more of something, or is it just takes time to build up the customer base and in the new markets? What limits or drives your growth?
Well, we don't jump at every opportunity. For us, it's managed growth. You mentioned the 40% and the 20%. Well, first of all, as I pointed out, we were coming off a low base after COVID, and that explains the growth spurt. To go from a 40% year-over-year improvement from that benchmark to the next benchmark, well, 10% of that was new business and 10% was essentially rolled over business. We don't have that 10% new business to add to this year. So I think what we're going to see now is more normalized growth. And I can quote you numbers, what our CAGR growth has actually been over the last 5 years, but then that includes coming off low bases.
Yeah.
So it's probably somewhat a little skewed. So I think for anyone trying to run a drilling business and that was planning what's our next 5 years going to look like, I would tell you that I think we're going to continue to grow at 10% per annum. And if we can continue to grow this business at 10% per annum and maintain the same margins, and that's really the Geodrill X factor here for investors, we generate in the order of 25% EBITDA margins. Okay.
Yeah.
And somewhere's north of about 10% net earnings. There isn't too many drilling companies in the world that are doing that. Now, if we can maintain that top line growth at a constant, call it 10%, and continue to move the EBITDA in lockstep and the net earnings in lockstep, then this is a business that if you generated, call it $140 million US. Pull out your computer and do the math. 10%, 10%, 10%, 10%. Inside of 3 years, 3 or 4 years, we're going to be at $200 million US. What's that? 270 Canadian, and still generating 25% EBITDA margins.
Do you think as you grow
and as this is a cyclical business, as we have demonstrated, we have worked out how to be a profitable business in the downside.
Yeah.
And ultimately where we would like to reach is the company that continues to pay dividends in a down cycle.
Yeah.
The bellwether of drillers, not necessarily the biggest driller. I never wanted to be the biggest driller. I'm interested in being the biggest driller. I want to have the least amount of rigs for the most amount of revenue, because here's the thing, very, very simply. Big rig our bigs generate, call it $2 million a year. Some of our competitors' rigs generate, call it less than $1 million a year. How many people does it take to operate those rigs?
Yeah.
Same amount of people.
Yeah.
Same amount of people. What's your biggest cost in an upcycle?
Yeah.
People. What's your biggest headache in an upcycle? People. So the emphasis doesn't need to be on rigs and monuments. You've got to have these things out there in the field and have them working. And so, our emphasis has always been on having the least amount of rigs, the most amount of productivity, because drillers are paid by the meter.
Yeah. Yeah. Well, I can't remember it off the top of my head, and I know you've published it here, but your return on invested capital, which is a lot of people view that as kind of the gold standard of how well a business operates. How much value do you generate out of every dollar invested? I don't. Do you remember what that is off the top of your head? But it's
it's in the zip code of about 25%.
A lot of
return on equity is currently 18%.
Yeah,
16% a year ago. So it's improving all the time.
Yeah.
The other thing that I really watch closely is our balance sheet. If we look at our shareholder equity, that is just something that just continually improves on the back, like after dividends, after a cash generation and cash generated and reinvested back into the business, that balance sheet, that shareholder equity just keeps improving. And we, through the year, earlier in the year, we went through the $100 million US barrier.
Yeah. And
so if you look at that and say, well, hang on a sec, convert that to Canadian, this guy's actually trading at under book value. We trade under book value. Yeah. This is the people would say, well, wow, the stock's done really well over the last 2 years. You're up 50%. Okay, but look at our financial and operational performance on the financial metrics. I was just doing the math this morning. We're back to trading after Monday's release of numbers.
Yeah.
We are back to trading at 2.5 times EBITDA.
Yeah.
It's crazy when some of our competitors are trading at 7, 8, 9.
Yeah.
And it's a beaten up sector. So that's why our competitors are trading at 7.5, 8 times. In an upcycle, they would trade at 11 or 12 times. We traded in the last upcycle at on average between the peaks and the troughs. We traded on an average of 4.5 to 5 times. So, if we're trading at 2.5 half times at the moment, just gives your investors the idea of how the deep value that still exists, even though the stock has you'd look and say, as the train left the station, the value is still there. It's as deep as it's ever been, actually.
One of the criticisms I think an analyst could make about your company is that you're actually under-levered on it. You have a fat balance sheet. And I'm not suggesting you should follow the route of private equity or anything, but if a private equity group, let's say, would get a hold of this kind of business, they would just rip out a ton of cash, jam in a bunch of debt, and just kind of like pocket that right out of the bat. I think there is a big opportunity for you to, I don't know, a lot of opportunity to return value to shareholders, but you're doing a dividend already, you've increased that, or share buybacks. If you levered up, you could, I don't know, you could do an LBO on this thing, my goodness. I don't know what the question is there, but I guess what are the options you're looking at, sort of value creation? You're below a real tangible book value. You're trading at a couple of times EBITDA. You're growing with huge margins. Like, the valuation looks like you're a broken company when you're actually a high-performing growth company. So any sort of thoughts on sort of unlocking additional value?
All of those things are great questions. You're not looking at a banker, by the way. You're looking at a driller. That's what I'm good at, is how to drill holes and keep the customer satisfied. And I think really what we're going to do is not try and overthink that side of the business. The approaches are coming thick and fast. They come all the time. I'm not interested in growing this thing into become a smaller part of a bigger thing. I'm only interested in what makes sense for me is to, I think, ultimately to be bought out.
Yeah.
Okay. But I will not get bought out at 2.5, 3 times EBITDA. That would be crazy. Why would I do that? So
how much do you own again?
It'll be.
How much do you own?
Sorry.
What percentage of the company do you own?
40%.
All right. So no one's going to be ripping this out of your hands for any kind of.
This will only ever leave my hands on my terms. Okay, yeah. And my terms will be quite simple. It ain't going to be 3 times EBITDA. It'll be closer to twice that number.
Yeah.
Okay. And so, we've always been for sale. It's just that everybody that comes along that wants to talk to us wants to talk about us becoming, a bigger thing and a smaller thing and a bigger thing. And it just makes no sense to me, folks that want to talk to us about merging with earth movers and all these things that are not our core business.
Yeah.
I'm not going to take my 25% EBITDA and blend it with someone else's 15 just to get a better multiple. It just makes no sense. I'll just keep growing organically. Yeah. And that way I still maintain the 25% EBITDA. And look, eventually we will be interested in talking to anyone that wants to take us out at a premium above where we trade. Yeah. And that'll be a good day for me. It'll be a good day for our shareholders. And until then, what shareholders have to look forward to is a 2.5% yield and growth. It's going to keep growing. The stock is $3. I don't know. It should be $4 in a heartbeat, I would have thought. Yeah. Hopefully after this call.
All right. I think we've hit the key points. We've pounded the table on this show, so to speak. Any final quick comments here before we wrap this up?
No.
All right.
I'm at PDAC.
All right. You're at PDAC. Well, have fun there. Don't go to too many of the parties. And Dave, that was enlightening and a lot of fun chatting with you after an excellent year you posted. Thank you very much.
Always great catching up. Thanks, Martin. Cheers.
Cheers.